All right, ladies and gentlemen, thank you very much for joining us this afternoon. We appreciate that you're carving out time out of your busy day to be with us, and we look forward to what is sure to be an informative discussion on the markets, which has certainly given us plenty to talk about, certainly over the last couple months. My name is Adam Paoli, and I am the founder and lead wealth planner for Cultiva Wealth Planning Partners. And allow me to welcome you to the second in the series of webinars we are hosting to provide our clients and their friends with useful information as we are prevented from being together person to person. Many of you know our team at Cultiva Wealth, and you know that we remain passionate about educating and helping people. Typically, most of our waking hours are spent face-to-face with our clients, helping them establish goals that impact their finances and their families, designing strategies to achieve these goals, and then executing them. And today we're still doing those things, but we're doing it a little bit more screen to screen instead of face-to-face. And along the way, we're blessed in that we have the ability and often build very deep relationships with our clients, and we're incredibly passionate about helping them any way possible. During our last webinar, we hosted an ER doctor that provided our clients with a frontline, unbiased view of what's happening with this virus that has dominated the news and certainly changed every one of our individual lives. And you may have seen actually in the news recently, there was some information about that our ER doctor friend shared about some of the different testing availabilities, and we're now starting to see that come to task. So we were kind of happy that we were able to get a little of a sneak preview on some of that information. But today's webinar is going to really focus on the markets themselves and how they have reacted to COVID-19. By now, you've received your quarterly statements from us, and you may be understandably uneasy. And to help those that we care about, we want to help make sure that we understand the current situation and what they can and should be doing about it. So as a result, we decided to bring in a resource from one of our partner investment firms to discuss what do we know so far about how the markets are responding to this, what it's going to take to sustain a recovery and a rally in the markets, and then how a long-term investor should respond to any of this. So before I introduce our speaker, here's a few quick housekeeping items. Number one, our webinar is going to be scheduled today for 45 minutes, and we're going to do our best to stick to that time so you can get back to the rest of your day. Everybody will be muted throughout this presentation. However, if you're having any technical issues, you can email me directly or message me in the Zoom application. And after we have some prepared remarks, we are going to have time for questions and answers. Several of you have emailed me questions ahead of time, and we will get to those. But if you do have questions along the way, please enter them into the Q&A section at the bottom of your screen. So without further ado, let me introduce our featured guest today. Kezia Samuel is the Director of Client Portfolio Management at AssetMark. She's responsible for writing commentary on market performance and current events, and taps from her 20 years of industry experience in order to do so. Good afternoon, Kezia. Thank you very much for being with us today.
Thank you, Adam, and thanks all those that have joined us in this discussion today on the markets and the economy. I just want to start with a quick thank you to all the healthcare workers out there on the front lines, taking care of each and every one of us, our friends and family out there. Today's discussion will break into three broad sections, so to speak. The first is going to be what we know so far, what has transpired in the stock, the bond, and the commodity markets. And then I'll pivot into and spend the most of today's discussion around what will it take for the market to have a sustainable rally, and then finally close out with some perspective for long-term investors on how to navigate market volatility and or environments like this. So let's start with what we know so far. The U.S. stock markets entered bear market territory, ending the longest bull market in U.S. history just days after its 11th anniversary. So we got to sing happy 11th birthday to the market, and a few days later it entered bear market. Bear market is defined as a 20% drop from the record high that was seen back in February 19th. And from there we dropped 20%. We did that in just 16 days. It didn't stop there. It continued to fall. In fact, it fell 35% on the worst case scenario from peak to the trough so far, and that happened in less than a month. Just for some perspective here, the last time we saw the markets drop 35% was no surprise. It was back in 2008 and 2009 during the financial crisis. But back then, it took the markets one full year, at which we did in less than a month during the month of March. So the speed of the decline was absolutely breathtaking. Since then, we have seen quite a rally on the way around as well. The lows that we saw, the bottom of the market so far was on March 23rd. And since then, the rally has been huge. Through last Friday's close, so from March 23rd through April 17th, the S&P 500 has gained 28.5%, and the Dow has surged 30%. So the question is, was the worst behind us? It is likely that market volatility will remain, and we'll talk about what are the cues that the markets are going to be focused on as we come through the next phase of the bear market cycle, so to speak. In addition, we had some strange things happen in the commodity market, things that I didn't think I would ever have to say out loud, such as on Tuesday of this week, if you entered into a financial contract to buy oil for delivery in May, they were willing to pay you $37.50 at a point in time so you could take the oil off their hands. What drove this is what I call the perfect storm, a trifecta. It was a demand crushed due to COVID-19. So around the globe, demand has absolutely fallen. We've seen demand being crushed by approximately 10 million barrels per day. Plus, we've had a supply glut as a result of Saudi Arabia and Russia continuing to pump oil to try and keep oil prices low with the aim of trying to kick out a few of the U.S. shale producers as a result of the fact that U.S. became number one in energy production a few years ago and has become energy independent, and their economies, which are mostly reliant on oil for its revenues, started to hurt. And so they were playing the short-term game to try and continue pumping to keep supply up and prices low. So they had no demand, excess supply, and finally add to that the fact that storage, where are you going to store the oil that you've pumped? Storage went from being 40% at capacity and went all the way to 70% at capacity, which is one of the key reasons. So combining all these three things together caused oil markets to dislocate for a few days earlier this week. Since then, it is likely that supply has been cut back significantly. Demand remains low, but nonetheless, oil markets have stabilized, and we have seen oil prices return to positive territory, and it no longer is available for all of us to fill our swimming pools with. This conundrum that we saw unfold in the stock markets and the commodity markets wasn't isolated alone to what we call as risk assets, things that tend to be volatile. In fact, we saw volatility also unfold in the bond market. Outside of U.S. government bonds, that is treasuries, the rest of the bond market also sold off as liquidity concerns and panic selling led bonds that were not backed by the U.S. government to also sell off sharply. So think of this. In a market where liquidity ties up, investors looking to raise cash, they wanted to sell anything they could get their hands on, and bonds which had a positive value along with gold, they started to sell those investments as a way to raise cash without having to sell things that were already fallen. So we saw volatility in stocks, and since then we have seen markets recover. We've seen a dislocation in the commodity or the oil market, and we've seen that stabilize, as well as we've seen a tremendous pressure in the bond market, which is one of the key reasons why the Fed stepped in so aggressively during the month of March, was to ensure that there is adequate liquidity and that this crisis, which is not a financial one like 2008, certainly did not unfold to become one as a result of some of the panic selling that we saw during the month of March. Since the Fed stepped in, bond markets have normalized and become stable. The relationship that we have seen historically, which is when stocks fall, bonds tend to rally, that is what we have seen return to markets over the last few weeks. With that said, was that the worst behind us? Is this all close clear? It is likely that going forward, in order to have a sustainable rally, markets are going to be focused on three key developments. And I'm going to paint the picture using a three-legged stool. Think of each leg to the stool as providing a piece to the puzzle, so to speak. The first leg to this stool that the markets are going to be acutely focused on is a successful containment of the virus in developed markets. To that effect, we have seen data that reflects a slowdown in the rate of infections as well as deaths in countries like China, South Korea, Italy, Spain, and even here in the United States in New York City. Overall, the data is positive that the countries have been successful in being able to flatten the curve. Again, flattening the curve does not mean no new cases, but rather means slowing rate at which the number of cases occurs. However, this decline in the growth rate of new cases is not the end of the story. Rather, it's the beginning of a new chapter. Turning the global economy back on is going to not be like a light switch. It is not a matter of on or off. Rather, I think it's going to be like a dimmer. It is going to be a slow, gradual process with differences in brightness between countries and sectors. So this first leg to the stool, this understanding of a containment of the virus, remains a developing story that the markets will continue to watch closely. The second leg to the stool is, well, as a result of this containment, what has the economic impact been? And here again, all of this has unfolded in a matter of weeks. So each day we get more data, but until we have significantly more data, this second leg will also remain a developing story. But let's start with the data that we do know. Over the last 4 weeks, we've had 26 million individuals claim for unemployment insurance. This essentially has erased all the jobs that we have gained over the last decade since the Great Recession. This suggests that the unemployment rate, which is currently at 4.4% in March, is likely to rise to the teens in likely the next number we're going to get is on May 8th. So the next unemployment rate number we're going to see is going to show that increase as a result of these individuals claiming for unemployment insurance. Now, while a recession is likely, the question that I often get asked is, this sounds far worse than the great financial crisis. I don't recall seeing this many number of jobs lost back in those days. It's important to understand that the economic impact behind these numbers as well. The areas affected by social distancing today have been predominantly in leisure, hospitality, retail, restaurants, transportation. And these sectors do represent a larger percentage of the overall employment. That is, 20% of the U.S. labor force, or roughly 35 million individuals, make up the labor force in these sectors. However, these sectors account for a smaller share of the GDP at 12% than did finance, which is banks and insurance, and housing, which have fewer workers, were at the epicenter of the 2008 crisis. Those two sectors, finance and construction or housing, those two sectors in 2008, which were hit the most, contribute 25% to our economic output. So even though we have a larger number of workers working in the sectors impacted today, its economic impact on a one-to-one basis is not one and the same. And this is predominantly driven by the fact that many of the workers in the sectors impacted today are part-time workers, also on the lower end of the wage scale. That is not to state that the pain they feel is any less than the pain felt by those that lost jobs back in 2008. And the CARES Act that was passed recently is aimed to soften the blow. In fact, directly impacting many of those that have lost their jobs in this conundrum that we face. The best way to think of the second leg to this stool and what has transpired is that the economy is suspended in animation. For any of you with children, grandchildren, you've likely seen the movie Frozen maybe more than once. I certainly have. My niece made me watch it a few times. The economy went from being fully functional and healthy to being frozen at a point in time. And that is likely to take an impact. But what is its full impact is yet to be determined. And as we get more data, this second leg to the stool will also remain a developing story. The third leg to the stool, on the other hand, is something that has been very much welcomed by the markets, and in one word, it's stimulus. Stimulus has come in two ways. Stimulus has come from the Federal Reserve, or the monetary side, that's called monetary stimulus, in which the Fed cut rates to zero. It has announced unlimited asset purchases, established several lending facilities. It also announced that it will provide $2.3 trillion in loans to support the economy. The actions taken by the Fed is aimed to ensure that any liquidity pressures felt in the financial system is alleviated, and it provides support for credit broadly. So think of what the Fed is doing is to try and get the financial systems to remain healthy so we don't turn this into a financial crisis. That is, get money into the hands of banks so they can continue making loans to corporations and the economy can function without having to seize up as it did back in 2008. On the other hand, if the Fed is focused on getting money into the hands of banks, the fiscal side of things, which is the CARES Act, is aimed at getting money into the hands of individuals. $2.3 trillion plus the additional $500 billion in Part 2 of small business loans. This is roughly 3 times the size of the stimulus bill passed in the wake of the great financial crisis. It is enormous. I don't know how else to say it. These numbers are big. On a high level, here's what's in this bill. For individuals with $75,000 in income or less, there's a paycheck of $1,200 plus $500 per child. There's a large increase in the amount of unemployment benefits you can claim. In fact, in some instances, many individuals are likely to make more in unemployment insurance than they would in their regular job. We've also seen how long you can claim unemployment for, and you've also seen small business loans in terms of forgivable loans or grants being accessed in this bill. For anyone wondering, I've thrown out the word trillions several times over the last minute. What firepower can be left after all the spending that has been done? The answer in one short word is they're willing to throw the kitchen sink at this problem. Both the Fed and Congress have stepped in a big, bold, swift, decisive way, and that has been very much a welcome note to the market. The best way to think of stimulus, if you think about what does this mean for us, I'm going to use an analogy. Imagine the economy caught the flu. Stimulus is like taking Nyquil. It does not cure the flu. It makes the patient feel better so that they don't develop pneumonia. In the case of the economy, it's ensuring that the small businesses that were forced into shutting down their businesses can survive this period of time so they can reopen once we resume some semblance of normalcy. So with that said, recall the 3 steps to this, the 3 legs to this stool. Containment of the virus remains an ongoing story. Understanding the economic impact also remains dependent on the first leg and will continue to have additional data. But this 3rd leg to the stool has been very much strong, bold, and decisive, and one of the key reasons why the market stabilized here in the near term. But having said that, there are an important set of unknowns that remain today. And without clarity on these 3 fronts, it is likely that market volatility will remain, and for risk sentiment, meaning for markets to have a recovery beyond that which we have seen, it will require significant additional data on that front. Ultimately, the roadmap to reopening the economy will be important to have a sustainable market rally, and we don't necessarily have to wait for 100% resumption in order for the markets to recover either. With that, I want to end to the last segment of our discussion, which is, well, if you've just stated that market volatility is likely to remain, we're still waiting for additional news on this front. The question that I often get next is, well, shouldn't we just wait in cash and wait for the coast to clear before getting back in? And here's what research has shown us, the results of doing so. We took a portfolio, a sample one of $10,000, invested into the S&P 500. So 500 stocks, we just invested it in the market. We started our investment January of '94 and went all the way through December of 2019. During that time period, that $10,000 portfolio grows to $112,000. We then look to see the impact of the portfolio. If you just miss 10, 20, or even 30 of the best days in the marketplace in that entire 26-year time span, simply missing the 10 best days drops the overall return by 50%. So instead of $112,000, that portfolio's return is cut in half to $56,000. And the results only get worse as more good days are lost. One of the reasons this happens over and over again is that while the worst performing days absolutely occurs during bear markets, so do many of the best performing days. Just as we've seen over the last few weeks, we had the worst day since 1987, and then 2 days later, the market had its best day in 100 years. And this pattern repeats itself during other bear markets as well. So trying to time the market without missing the top 10 days is likely to require surgical precision. And it's very hard to do that consistently. So instead, as investors, what we can do is to ensure that our risk tolerance is appropriately set. And we likely, all of you have had a financial plan in place in order to ensure that these short-term bouts of volatility that we experience and is likely to experience, this is likely not the last time we will experience volatility as part of our long-term investment, but how we react to these types of volatility is a fundamental key to ensuring how we adapt and succeed relative to our long-term goals. With that, I want to pause there and see if I need to clarify anything I have shared and or jump into the Q&A.
Thank you, Kezia. That was a lot of information and done really well. Folks, if you want to throw in some question and answers, again, at the bottom of your Zoom toolbar, there is a Q&A section, so feel free to answer. We've already had a few people who have chimed in both ahead of the call and some that have chimed in during the call. One of the questions that came in just as a follow-up to the unemployment question, that you had mentioned that it's jumped to unprecedented levels, and from everything we're being told in the media, you said it absolutely right, that seems like it should be way worse than what we saw in 08 and 09. You certainly clarified the difference between the types of jobs where they're at on the wage scale. But some of the business owners that are small business owners that have seen this have shown some concern of how do we get these people back to work that, as you mentioned, may be getting more income in unemployment than they are currently. Do we have concerns about how that's going to impact the market? And does that have the potential to slow down the thawing of the frozen economy, as you put it, because those folks are not going to be incented to get back to work?
So, yes, in some arenas, as I mentioned, when you pass these ginormous bills on such short time periods, it is likely to create competing interests. So unemployment insurance in this instance is potentially, at head with some of the employers who are trying to keep their employees on the payroll. But note that it's only lasted for 4 months. So this extended or additional benefit in unemployment insurance is aimed for 4 months, and thereafter it goes back to the normal route. So you can claim it for a longer period of time, but the extra amount you're getting is sort of in line for the next 4 months. Well, with that said, though, it is one of the reasons why they did this additional small business loans. And small businesses remain the fabric of the way the United States operates. I know we often hear the big companies being discussed in newspapers and television, but it is the small business where innovation starts. Now think about the companies that today are the big companies, one day started in someone's garage. Google starting in someone's garage. They were small companies, and they are absolutely essential to ensuring that competition, innovation continues to remain. And I think the way the loans have been aimed, hopefully they've addressed some of the red tape that was built into the first version to ensure that these businesses survive and can thrive beyond this time period. So yes, they've sort of rectified version 2 to address some of this, but some of the side effects of doing deals like this so quickly is the unemployment insurance in some instances outweighing the need to retain employees. So that's a side effect. It's always part of the normal course when you're doing such big deals. But I think the small businesses they have tried to address in a better format in round 2 of the loan that was just passed.
Understood. And you also talked a little bit about oil earlier. It's been impossible for you to turn on your television or your radio this week and not hear news about oil and the impact of oil. And you mentioned that the kind of the futures and the options issue that was for basically a very temporary basis on April 21st has resolved and stabilized and is positive. That being said, there is certainly a supply and demand issue in oil. Can you speak a little bit to what you believe, just moving forward with the fact that our economy is frozen, consumption of oil is low, what that's going to mean to the broader economy, and then specifically to energy companies? You mentioned, it's kind of, as we look at selectivity of stocks, and we'll get into that, what do we think the impact of what seems to be a forecast for low oil prices for a prolonged period of time, what do you think that will do to the markets in general?
So generally, low oil prices are a boon to the U.S. economy, but that assumes that demand is normal. In this instance, you will continue and likely to have low demand and excess supply. So even with the OPEC deal to cut back supply, to give you an example, we've had demand fall by 10 million barrels per day, but we have an excess of 30 million barrels in comparison per day. So the volume of what the supply exists is vastly higher than the demand itself. So it's likely to keep a cap on oil prices. Having said that, in oil sector, there's likely going to be what I call as the big Pac-Man eating the little Pac-Man, meaning consolidation. So you're likely to see some of the smaller shale companies that require oil prices somewhere in the range of $40 to $50 in order to remain viable and profitable, are going to be eaten up by the bigger companies. Even in the larger energy companies, this general sector, it really requires selectivity. And here I've had questions asked my way, which is, surely some of these companies are trading at such deep discounts, it can't be it's a no-brainer. Or the oil ETF, that's seen questions come through, that oil ETF, surely it's a no-brainer. What we're seeing is that there is a retail flow into some of these. We're not seeing institutional flow go into these arenas. Where we see institutional flow is going into selective stocks. There are going to be winners and there are going to be losers. But in order to evaluate that, it's important to understand each company's balance sheet. What do they own? How much cash flow do they have? Do they have the ability to navigate this crisis for the next, especially in the energy sector, for the next few months? Can they survive and thrive down the road? And the only way to do that is if you are fundamentally connected and you can actively evaluate each stock individually. So it's important to not be, led into believing that just because something is being offered at a very deep discount, surely that has to go up. And in this instance, I think you're going to see a variation between the winners and the losers. And the only way to know that is to know the companies on a one-on-one basis, so to speak. Long-winded answer, Adam, but hopefully I got to answering that question.
No, absolutely. That's incredibly helpful. And then I'd like to kind of extend that to the broader markets that you mentioned, that when it comes to oil and specifically in the energy sector, that individual names are going to be the conversations we should be having as opposed to buying broad indices and or individual plays and things like oil. Talk to me about your thoughts generally, where the markets are going to go moving forward and what you guys are recommending for long-term investors in the kind of passive versus active conversation. That if you saw coming out of 2008 and 9, it seemed to be that a rising tide carried all ships, and there was a lot of chest bumping by some of the ETF companies that said active management is antiquated, outdated.
Dead.
You just needed to be in the markets and you were going to thrive from that. Do we think that this is somewhat of a turning point for that active versus passive debate?
If March was an indication that perhaps passive doesn't always work, then I'm not sure when it would be. during the height of the volatility in March of 2020, ETFs dislocated from their indices. And the reason that happens is when liquidity disappears in the marketplace, as we saw in March of 2020. This is one area that we believe is likely to reappear as we have crowded ourselves into these passive vehicles. With that said, it is today, if not, I'm not sure what other time, active management has a fundamental role in portfolios. Over the last decade, yes, if you just bought the broad market index or ETF, you were fine. But today, I'm not sure how that could be the case if each company on what they have in terms of their strategy and their balance sheet and how much cash flow they own can vary night and day. And we have seen markets are deciphering that difference, but nonetheless, even within each sector, the variation on stock performance is night and day. So there's opportunities to be had, but I'm not sure how you could capture all of it by simply being passive. That is not to say passive needs to be replaced, but it is complementary to where active managers can add alpha during times like this for the long-term investor. And I'll end with the question that you asked, which is, where are we likely to be? No one knows exactly where the bottom is. No one knows exactly where the top is. But if I were to take a deep breath, take a step back, and take a look up at the sky, and by that I mean take a much more broader perspective. Since 1926, we go all the way back then, and you study the S&P 500 markets from then through 2019, in that entire 93-year time span, we have seen the average bull market has been 6.6 years, during which we generate a cumulative total return of 380% or so. In comparison, the average bear market is 1.3 years, which generates a cumulative total loss of 38%. So one of the things that we have seen over and over again, this crisis, like others, will dissipate. I certainly don't know when, but for the long-term investors, stocks have added significantly additional value for that long-term tenure consistently over time if we are patient with the stock markets, that is.
Understood. And you said earlier when we talked about some of the rapid speed of the decline that we saw in the markets, specifically the stock markets in March, we talked about volatility being at highs, and we're not out of the woods quite yet on that volatility, but there's been a lot of talk out in the media about the recovery and the shape of this recovery. I think we all agree that a recovery is coming. It's a matter of when and how. And so I'm certainly not going to ask you for the when, because that would be asking you to pull out your crystal ball. But talk to me about the how, that when we see this recovery, this idea of this V versus U-shaped. And for those unfamiliar, it's just how rapidly we see this respond. Are we of the belief that when we do respond, because of all the stimulus, the financial footing we were on going into this, that this will be a quick recovery or a V-shaped recovery? Or are we anticipating that we're going to still need to see some time to see this all play out, and it's going to be not necessarily so sharp on the way up, but more of a steady U-shaped recovery? Can you share your thoughts on that?
Sure. And thank you for setting the stage on what the different shapes to the recovery mean. But it's important to understand that the shapes of the recovery that we often discuss are related to the shape of the recovery in the economy. And the markets don't necessarily follow suit to the shape of the recovery in the economy. For example, the stock markets and the economy are related, but they're not one and the same. We often see that stock markets are forward-looking while the economy is backwards-looking. The stock markets can tend to fall well before the economy starts to show bad data and recover on the same venue and start to rise well before the economy actually heals. So we think likely it's going to be a U-shaped recovery in the economy. But nonetheless, more importantly, what it means for all of us is if we wait for the economy to fully heal, it is likely that you will miss significant components of the rally in the marketplace. And let me elaborate a bit on this because we did some research around this. we looked at years since 1930, in years during which the market was the economy was in a recession, and how did stock markets react during those years? There were 18 such years. In 12 of those 18 years, stock markets were positive despite the fact that the GDP or our economy was in a recession. And in those 12 years, the stock markets averaged approximately 18%. In fact, we saw this just in 2008 during the Great Financial Crisis. Markets hit a peak in October of 2007. And guess when the recession was officially announced? 14 months later. Same thing. Markets bottomed in March of 2009 and started to recover and rally and never looked back. But guess when the recession was announced to be over? 16 months later. So I use this to describe the fact that we often focus on what will the shape of the recovery be. That is tied to the economic recovery, but the recovery in stocks are not likely to follow the same time period as we see in the economy. I'll end with this. The analogy that I use to describe that, it's like if you got in the car today and decided that the only way you're driving is by looking in the rearview mirror. Meaning, if you wait for the economy to heal, it's like only looking backwards to move forward, because likely that the stocks and the economy move while related to each other at different time periods altogether. So hopefully I've elaborated a bit more on that question. Adam, let me know if you need me to clarify what I shared.
No, I think that's helpful and in a good disparity back and forth between the two, that ultimately, even though the markets themselves, the differentiation between forward-looking and backward-looking, I think, is an important distinguishment for our clients to say that even though the economy is going to come out with reports moving forward about, first quarter and second quarter GDP and revenues, et cetera, that even though there will be negative news there, that is somewhat to be anticipated given this, and the market is really pricing that forward. They're not looking to the current and past quarters. They're looking to what they believe the impact of the current market environment is going to be on the future. So I think that is certainly a very helpful reminder. And with the time we have left, we've got time for one more question. And this is I like ending on one of these positive ones. Let's talk about what positively has come out of this. I think there's some that would argue that spending more time with family has been a positive, but from the markets and to the individual consumer, things that we can highlight and we can see that borrowing costs are incredibly low. As you mentioned, oil prices being low, meaning gas prices are low, that once people are out and able to use their cars again, it will be cheap to be able to do that. Maybe be able to get some deals on cruises and other travel related issues. But what are some positivity and what things would you say walking out of this? What can I feel good about on the footing that we're at today and look to the future with optimism and anticipation?
Several things. First, as a result of being forced into this COVID-19 crisis, we are likely to see medical innovation on this front. Recall that the coronavirus umbrella has included a variety of different viruses from the past, SARS, MERS, they're all related. But they didn't last long enough for us to have a medical address to it. So first is medical innovation. Second is reassessment of supply chain. Over the last 2 decades, we have seen outsourcing and or restructuring supply chain outside of the U.S., in some instances concentrated in certain parts of Asia. It is likely, as a result of this, many companies will reevaluate if they should have concentrated pods in their supply chain that impacts their businesses. So likely to see some of those jobs and or efforts being returned and or diversified here in the United States. Third, it is likely, and I don't know if this is non-financial related. I tend to go for walks every day in my neighborhood. I have never seen so many people in my neighborhood before. Families are out and about. I saw families playing lacrosse with each other. So on a personal note, it's very nice to see people engaging with each other. Sometimes perhaps we just need to slow down, take a breath, and enjoy the things that are right in front of us that often gets missed in our busy day-to-day lives. So a bit of what's positive on the financial front, but also what's positive on a personal front. That's how I would answer that question.
Yeah, not only innovations in healthcare, as you mentioned before, but hopefully all of us walk out of this in better shape if we're doing more walking than we've ever done. There's the downside drag of the health clubs being closed, but hopefully a little bit more walking around, more sunshine and more fresh air will be better for everybody's health as well, right?
Can't imagine it hurting.
Absolutely. Well, Kezia, we can't thank you enough for lending us your time and your expertise today. We know you're very busy, and we appreciate your insights. And we're glad that not only are you getting out on more walks, but you're using this time to catch up on your Disney classics and Frozen. Make sure you catch Frozen 2. You'll like that even better, I would imagine. But thank you so much for being with us, Kezia.
Happy to.
All right, ladies and gentlemen, well, that concludes our time today. Again, want to thank you very much for taking this time. Although these are indeed unpredictable times, we hope that you find comfort knowing that your team at Cultiva Wealth is here working hard and making sure that we are keeping what's important in front of you, and we're available to discuss whatever's on your mind. Our goal continues to be doing whatever it takes to help you look to the future with anticipation and not anxiety. One thing I wanted to mention, Kezia brought up the study that she mentioned with respect to the days out of the market. We have pieces on that we would be glad to share, and we'll make sure we distribute to everybody who's on this call list. But if you have any other follow-up questions that you'd like to ask, don't hesitate to reach out to us directly. And as we've shown and you've seen in other emails that we've sent out, we've recently announced that we've extended our hours and have invested in technology to allow these discussions to continue until we are allowed to meet face-to-face again. So again, please do not hesitate to give us a call and reach out to us. We are glad to be a sounding board to you and your family and those that you care about, because if they're important to you, they're certainly important to us. So with that, we'll close this out today. Thank you so much. Please stay well, make healthy decisions, and we hope to see you face-to-face soon. Thanks so much.